Good morning, our dear clients and members. I believe the 5 minutes grace period has elapsed, so I believe it's a good time for us to start. As mentioned earlier, my name is Eve Wangare. I'm from the Marketing and Communications Department, and together with the Octagon team, we have prepared this online pension clinic for you members to offer guidance and insight into this journey of retirement. I will take this opportunity to make you feel welcome in this chilly morning in Nairobi. We are seated at our head office in West Park Suites, and most of our team is also working from home due to the COVID restriction and protocols. But all in all, I believe we are going to have a very engaging session, and feel very free to input your questions or any queries that you might have within the session. Yeah, so as housekeeping rules, I would request, if you have a question, you have on the screen, you can see there is a chat icon. Once you click on that chat icon, it shows show conversation. Feel free to click on it and also type any question or any query that you might have within in the course of the session. And then we'll have our trainers of the day taking time in answering them and also giving you clarification. Yes, and then if you feel your question or the query you have needs you to actually speak about it, kindly just raise your hand and we'll enable your mic, and then you'll be able to speak and address the meeting. So feel free and feel this is a platform that is you're very welcome to engage and also to just input any queries that you have. Yes, so I will take this opportunity to introduce the team from Octagon. We have our trainer of the day. His name is Jonathan Langat. Jonathan Langat, he's the business executive he handles insurance matters. Jonathan, kindly just unmute and address the meeting and also introduce yourself.
Good morning to our clients. My name is Jonathan Langat from the insurance department. I'll be taking you through the different types of options that you have after retirement. So I'll be taking you guys through annuities. Thank you.
Thank you, Jonathan. Yes, he's the one who will be taking through us the products that we can access during our retirement. And also in this meeting, we have a trainer. His name is Michael Coleman. He's also on our pension side of the business. So Michael, kindly introduce yourself and also mention the topics that you'll be handling today.
Good morning, members and my fellow colleagues. My name is Michael Coleman, from that is representing the Pension Admin Department, Octagon Africa. And today I'll be taking you the product which are related to retirement products. I think this will be a very informative session, and members, at the end of the day, you got something you have learned. Thank you very much and have a nice session. Thank you.
Thank you, Coleman. You're also welcome. And also in this meeting, we also have our customer experience manager. Her name is Monica Shiwalso. Monica Shiwalso handles all the queries that are member related and also offers insights and guidance in any kind of challenge that our members and clients experience. Welcome, Monica.
Thank you, Eve. Welcome, members. Feel free. This session is ours and yours, basically to just share ideas on best practices to be prepared for the longest holiday of our lives. So feel free, feel welcome, and welcome. Thank you.
Right, thank you, Monica. Also, we have Rogata Nafula. Rogata Nafula, I'm sure most of you have interacted with her before. She's our business development officer, and she is actually the brainchild of this session. And she is the one who interacts with the clients and ensures at least members and also our clients are able to join, and they have a smooth transition in getting the insights that are offered on this platform. So welcome, Rogata.
Good morning, members. Good morning, colleagues. My name is Rogata Nafula. I'm glad to have you today. I'm looking forward to an informative session and more questions afterwards. Thank you and have an enjoyable session. Thank you.
Thank you very much, Rogata. Okay, so dear members, will allow me to take just 5 minutes to introduce our organization, that is Octagon Africa, and so that we understand where our dream comes from and why we are very keen in advancing the pension industry and also the financial inclusion. In the meantime, I will ask Rogata to kindly check on the members that are joining the session and admit the members so that I can be able to handle these. Okay, so Octagon Africa is an award-winning leading regional financial services company with a significant industry consolidation within the non-profit, public, and private sector in 5 strategic divisions, namely pension, insurance brokerage, training, and actuarial services. Our vision is to enrich lives through innovative financial services and solutions. We are committed to safeguarding the future of our customers through lifelong learning, such as this platform. We also ensure this when looking into risk management and retirement solution. Octagon, we are regulated by Retirement Benefits Authority as well as the Insurance Regulatory Authority. As a journey, we started our journey 14 years ago, and right now we're operating from our head office at Westpark Suites on Ojiji Road. You will find us on the 8th floor. So we have an open doors policy, as much as we also adhere to the COVID guidelines and protocols. We are open to hear your queries and also to offer your solutions. So we have now spent 14 years in serving clients across Kenya, Uganda, and Zambia. And in our incorporation, we have a good story that started in a garage, and we were founded by our group CEO and founder. His name is Mr. Fred Waswa. From there, we made our footprint in Uganda and Zambia in 2013, and also Zambia. We went to Zambia in 2017. In 2017, we also established the Institute of Pension Management. This is the first institute in sub-Saharan Africa that trains corporates and individuals in the retirement benefit industry. And in 2019, we launched Mobikeza, an innovative pension product geared towards retirement benefits for the informal sector. This means that even if you're not, you don't have a formal employment, you can also get pension through the Mobikeza app. And it's just by dialing *237#, and within minutes you'll be able to have a pension plan, and you can be contributing to it. In the industry and also as we seek to advance the pension solutions, we partner with like-minded institutions. And in 2020, just before Corona, we got into a strategic partnership with Alexander Forbes Group Holdings. This is a like-minded, market-leading, advice-led provider of integrated retirement and investment solutions. And this partnership has brought investment consulting capabilities that we didn't have before. And we are now at a global international, we are now able to do our research on a global and also international level. This partnership has also brought about human resources, product development and innovation to our portfolio. So members and our clients, as you can see, we take pension advancement very seriously, and we partner with like-minded individuals and organizations so that we can ensure we are advancing this agenda and also impacting more lives as we go about it. As mentioned before by my colleagues, we also have pension solutions for individuals and also corporates. For these, we handle clients in the formal sector, and I'm sure most of you are coming from maybe a formal sector, but we also handle clients from the informal sector. Our corporate solutions profile, we work closely with businesses and service providers and trustees of pension schemes to equip and empower them to discharge their duties diligently. We focus on key consulting areas such as corporate governance, quality control, system policies, and then professional indemnity, disaster recovery, audit, business continuity, and also emergency response. Our products for individuals, they include our Octagon individual pension plan that will help you save money for retirement and is available to anyone who is above the age of 18. I also mentioned we have Mobikeza. This Mobikeza app actually targets people who are as boda riders, and from as little as 50 shillings or 10 shillings, you can be able to have a pension plan and also a retirement plan. I think I will just touch our key milestones so that you understand if when we're saying we are award-winning, what awards have we won. As an award-winning leading regional financial services company, we have been named in top 100 mid-sized companies for 2 years in a row. That is in 2018 and also in 2019. In 2016, we were named the best pension provider in Kenya by the World Finance, and in 2020 we emerged as finalists in World Pension Summit for an innovation within the African financial industry space. And this award actually focused on Mobikeza, because Mobikeza, as it is impacting lives and is also advancing the financial inclusion agenda. So with that, members, I'm sure right now you have a brief knowledge of who Octagon is, and I think now it's a good time to welcome my trainers of the day, and also now so that we can focus on the agenda and also the insights that they're going to offer today. So I want to start with Michael Komen. Michael Komen, feel welcome feel welcome. So I hope you have prepared insightful insights for our clients and also members. So karibu sana, and this is over to you.
Thank you very much, Eve, for the brief introduction about who Octagon Africa are. So I think since you have dealt with the first part of the presentation, that is in terms of who Octagon are, I'm going to do a presentation. My presentation would be, I'll dwell basically into options. We are going to look into the first part that of our presentation is that I know most this is the time whereby we call saving period, whereby you are accumulating wealth. As you approach retirement, you'll be having, this will be now the period of now what we call utilization period or season. This is whereby you are now taking advantage or making use of what you have saved to sustain you during the period of retirement. Just to highlight is that the main reason as to why people are saving is to actually to move away from the myth of previous, whereby we used to believe that you among the options of investing for yourself to protect yourself during retirement is whereby it used to be you need to invest on your kids. You need to invest on having as many kids as possible, because those are the people to protect you. But however, we are moving away from that myth, whereby you need to plan yourself for the purpose of retirement, because the way life is today, you find that you will have kids and they'll grow up. Once they grow up, some will even forget their parents. They never even think about going back to a country. They raise you, then they go and raise their own family. So you find that it become a new era, whereby during your active season, you should always consider that you save enough so that it can sustain you during your retirement. Key things that need to be mentioned about retirement is that we have 3 key components. As a member, you need to factor in while you think about your retirement. The first one is what we call housing. That will be the main, you need to factor in that upon retirement, you need housing. The second component will be income. You need to have something that will be giving you the income. Remember, maybe today you are in employment and retirement will come. It means that when the organization now tells you it is time for you to leave, or we appreciate your service and now we need a fresh blood, it means you are going outside the organization and it marks the end of your salary. So you need a replacement income, and that becomes the second key component you should think about retirement. The third key component is what we call medical. Upon retirement, your health is come as a priority as well, because at the end of the day, people, it has been proved that upon retirement, people become more vulnerable to diseases. You can see even for the COVID-19, I think people who are vulnerable, who are being considered to be someone above age 58. And that brings the question is, if you go to retire, remember that today, while you are still in employment, you might be in an employer who is providing for you a medical cover. So when you go to your retirement, it means now the cover has ended for the employer, and you need to be covered, to be put under cover. And among things which I recently we have seen is that people at the retirement, they depend on what we call the National Insurance Fund, that is NHIF cover. At times it might not be sufficient, so you find that it might be becoming very expensive. So during your active season, I believe during this time, think about those 3 components, that how are you going to sufficiently touch based on. So I think I'll not touch on anything about who Octagon are. I think this was captured by my colleague Eve. So allow me just go directly to the retirement options. I think just to mention is that in Kenya, we consider that retirement age, we have 2 forms of retirement age, whereby the first retirement age is whereby we consider that we have 50 years, whereby we consider that to be the retirement age. However, have actually I can say 3 types, whereby we have the normal retirement age and we have early retirement age. So as a member, when you attain age 50 and you leave any organization, you will be considered as a early retiree, or you have retired on the basis of, you have left the organization on the basis of retirement on what you call early retirement age. And the second is whereby someone goes to the normal retirement age. The normal retirement age in this country is 60 years. So the 2 are considered to be now to be retirees. So it means that when you attain those ages, you'll be considered to have retired from service. And to mean when you attain that age, it means now you are moving from active employment or from working or servicing, and now it means you are on retirement. What will that basically means is that now you are heading towards a period whereby you are now depending on what you have saved as your pension. So when you attain this retirement age, it comes with various options. The first thing that as a member you look into is what you have saved in your pension scheme. What are the amount that you have saved? So it's always very important as a member, before you attain that retirement age, you should have made decision on which option you are going to take advantage of. Are you going to access your benefits, or which options are you going to access your benefits? Because we have 2 ways in which a member can access his benefit. The first way is whereby, depending on the type of the scheme you are, or depending on where your saving currently is, you will be given options in which you can be paid your benefits. The first option is whereby a member is paid what we call a cash lump sum. So in this situation is that when you attain your retirement age, a member, if you are in, you need to understand what structure is your scheme. If you have, we have two forms of structures of a pension scheme. We have what we call a provident fund, and we have what we call a pension scheme. Looking into a provident fund, if your scheme where you are saving in today is what we call a provident fund, it means at the point you attain your retirement age, you are at the option of whereby you can make decision on how you would wish to access your benefits, whereby you can say, I want to take part of it and purchase what we call an annuity, and part of it or annuity or an income drawdown, and then the other part I can be paid as a cash lump sum. That is for someone under what we call a provident fund. And the second form structure of a pension of a scheme is what we call a pension scheme. In a pension scheme, this is very elaborate way in which benefits can be paid to you. The first option is whereby you'll be told you'll be paid what we call a third, 1/3 of your pension benefit as a cash lump sum. That is what you can be paid directly to your account. The remaining portion would be converted to what we call a monthly income, or it will be converted to that, it will give you what we call a monthly income, which in this situation is that it's either giving you an option of purchasing an income drawdown, and the other option of purchasing an annuity. And that brings us to the question of the day is, what are these two options? What is an annuity and what is a drawdown? So for this case today is that I'm going to cover on what we call an income drawdown, and my colleague by the name Jonathan will cover the other options, and that is annuity. I think he'll be able to give you that option. I've seen one of the member is saying is unable to see my presentation. Kindly allow me check on it, and then shortly. Just a minute, I think it's coming up shortly. Is there anyone who can see my screen now? I think.
Yes, Comment, we can see your screen, only that
Yes.
it's not in full screen mode. So kindly
Okay.
put it in full screen.
Just a minute. Just a minute. If I think I'm having a challenge in posting it in to have it a full screen.
Okay, just present and then share your screen, and then I will direct you to do it.
Okay, thank you. Okay, I believe now it's I can just proceed.
Okay, we can't see your screen just yet.
Maybe if you can present on his behalf.
I can, but maybe kindly share your presentation and then I'll be able to put it up.
Okay.
Maybe just to request all our attendees to kindly bear with us as we set up the presentation. We greatly appreciate the fact that you spent time to join this webinar. This is among a series of webinars that we are doing to ensure that you as our client has value and gets to know what options do you have, especially as when you are approaching retirement. So we are here. So make sure you have all your questions. Sure, my colleague Eve must have informed you in case you have any questions. This is the best place to ask, whether it is from choosing which annuity to go to, whether it's choosing a drawdown, which one to do, how is taxation done, nomination of beneficiaries. There is a lot that we can be able to learn and share within the day. So as we wait, we kindly ask for your indulgence as we set up the presentation.
Thank you, Davis, for holding the fort. Members and our clients, Davis is our general manager, insurance brokerage side of business. And thank you for the solution. But I'm understanding my colleague, Michael's computer has completely gone off. But with that being mentioned, that doesn't mean we will miss out on the insights that we had planned for today. So I would request my colleague, Jonathan Langat, to save the day and actually maybe take up the presentation, and also we can hear from his side. So Jonathan, I hope, sorry for the ambush, but in this event, kindly present and also address the meeting.
Thank you, Eve. Allow me to present my presentation. I think let me do something short on the income drawdown fund that Komen was doing. Now, as Komen said, at the point of retirement, one will have two options to do after having the lump sum paid to your bank account. The 2/3 you'll be able to either purchase an annuity or an income drawdown fund. Yeah. So for an income drawdown fund, one of the features is that the income is not guaranteed. Yeah, it's entirely dependent on the performance of the market. So these monies will be invested, and your income is dependent on the performance of the investments that these monies will be. Now, Another thing about the income drawdown is that it's flexible. Yeah, you'll be able to choose the frequency, the timings, and the amount of withdrawals that you'll be able to do in the course of the period. Yeah, and in selecting an income drawdown arrangement, you assume that the investment and longevity risk. Yeah. Now, the payments are paid until the fund is exhausted. Yeah. And this is mostly after 10 years. And there'll be a lump sum that will remain, which you can be able to use to purchase an annuity. That is at this point. Yeah. And in the event that, God forbid, the member passes on, the balance is paid to the beneficiaries, which the member shall appoint at the point where you are taking up this income drawdown fund. And the other thing which is an advantage is that a member has full control of the withdrawal amount. Yeah. So now let me go to my presentation on the annuities.
Yes, thank you, Jonathan, for also stepping in and saving the IDD. I would request if you can put your screen in full screen mode so that our members and clients can be able to view. Yes, thank you very much.
Okay, I hope you can all see my screen.
Yes, we can.
You kindly confirm.
Yes, we can see your screen.
Okay, now I'm going to take you through another option, which is the annuity, which an annuity is a perpetual payment, which is made to an annuitant for as long as they live. Yeah. So basically what this means is that an annuity is a fixed sum of money, which is paid to an annuitant each and every month, which typically is for the rest of your life. Yeah. And this can be purchased from the age of 50 years. As we all know that the retirement age is 60 years and the early retirement age is 50 years onwards. Yeah. And these monies are subject to a minimum guarantee period. So for an annuity, it protects you from running out of money. The 2/3 that you ought to buy an annuity or an IDD with is invested, and this means that when these monies are invested, you'll be getting a monthly income for the rest of your life. Yeah. So you transfer this risk to an insurance company, and in turn, the insurance company is going to pay you something like a salary for the rest of your life. Yeah. So one is advised to save enough so that you get a good starting income. This is because the monthly incomes also will depend on the savings that you have. Yeah. Now, we have 3 types of annuities. We have the single life annuity, which most of our clients actually choose. This is an annuity contract that makes a series of payments at fixed intervals as long as the annuitant is alive. So this is the basic form of annuity, whereby you just take the annuity as a single life for yourself. And then we have the joint life last survivor annuity. Yeah. This provides an income for life to partners in marriage. So basically, when you are taking up this type of annuity, you take it up with your partner in marriage. Yeah. So these payments will be paid until the passing away of the last surviving partner. So what it means is, if you take up an annuity and you take up a joint life last survivor annuity, and then God forbid you pass on, maybe in the 10th year, yeah, the monies will still be paid to your partner in marriage, to your spouse, yeah, until now the passing away of your spouse. We have another type which is called the reversionary annuity. This is just, I'll say it's like the joint life last survivor annuity, but this one extends to children, yeah. So you can extend it to a spouse in marriage and also to the children. So this can be paid, this can go on and be extended to payments to children upon the death of a principal annuitant. Yeah. So these payments will be made until the passing away of a last surviving partner, and also or until the orphans attain a particular age. So at the point where you are taking up an annuity, what we'll do, we'll advise you that we have these particular annuity providers, and then for us to give you a quotation, what we'll need is the name, the retiree. We'll also need the date of birth or the age of the retiree. We'll also need the gender of the retiree, and also now the purchase price. So when we get these four requirements, what we'll do, we'll source for quotations for our partners here who offer annuities. So this is how a quotation will look like. As you can see up there, we have the client's name, the gender, the date of birth, and the purchase price. Yeah. Now, basically, this is how a quotation will look like. The features of a quotation, you can see that there is single life, there is joint life last survivor, and then there is joint life last survivor. This is 100% reversion and 50% reversion. And then we also have the escalation and the guarantee period. Yeah, these are the features of a quotation, of an annuity quotation. So let's debunk these terms of a quotation. So an annuitant is an individual who receives this income under an annuity contract. So an annuitant basically is you. Then, as you can see, the escalation period. This is the percentage increase in the annuity payments every year. As you can see here, let's use the example of the single life. Annual escalation is usually 0%, 3%, and 5%. So basically, what the 5% means, it means that your income will be increasing by 5% every year. Yeah. So if you take up a cover, let's say 1st of January 2021, on 1st of January 2022, the amount that you used to receive will increase by 5%. Yeah. Basically, what this does is that it usually cushions you from the inflation rate, which, as you all know, the inflation rate at the moment is it's slightly above 5%. So basically, this is the percentage increase in the annuity payments every year. If you take up the 0%, this means that there'll be no increase in the payments each and every year. So if this member takes up the 0% and then guarantees it at 20 years, the monthly pension will be at 32,340. This amount will be paid to this member as long as they live for the rest of their lives. Yeah. If you take up the 3% and you guarantee it for 20 years, the monthly pension will be 25,310. This is for the first year. For the second year, this amount will increase by 3%. Yeah. And so on and so on. Right? Now, the guarantee period. This is the minimum period that the annuity payments must be made, whether the annuitant is alive or not, for the purpose of protecting the purchase money. Yeah? So I would like to be clear and say that the guarantee period does not mean that the annuity will be paid for only 10 years or only 15 years or only 20 years. Yeah, this is the period where the annuity payments must be made. So let me give you an example. If you take up a guarantee period of, let's say, 20 years, you'll be paid for the rest of your life, even if you live past 30 years, 40 years. Yeah? But the guarantee period comes in cases where, God forbid, you pass on maybe in the 5th year, or let me give an example of the 10th year. Yeah? So if, God forbid, you pass on in the 10th year, this means that you have 10 years left in your guarantee period. Yeah? And these monies will be paid to your beneficiary. Yeah? So that's what the guarantee period, that's where the guarantee periods come in. And then the reversionary factor, this refers to the percentage of annuity income that translates to a surviving spouse pension or orphan pension under the reversionary annuity contract. So as you can see from this quotation, we have the joint life plus survivor 50% reversion, and then we have the 100% reversion. So if you take up the joint life plus survivor 50% reversion, this means that in the event that the annuitant passes on, your spouse will be paid these monies that you've been earning monthly, but will be paid 50% of these monies, right? And then if you choose the 100% reversion, it means that now the spouse will be paid the full amount of these monies in case you pass on. Yeah. So I think that's the end of my presentation. I'll be able to take up any questions on the annuities and the income drawdown. Or if we can take up the questions, then we can answer them later.
Yes, so I think we can start taking the questions because we have several that have already come in. One of our guests, his name is Boniface, he's asking, I contribute personally monthly to Octagon Pension Scheme. How can I benefit in terms of tax allowance when I file my payee returns? Yes, please, Mike, you can actually take that question.
I can take that question.
Yes.
Thank you very much, Boniface, for your question. When it comes to taking advantage of tax exemption, I think one thing to mention, there are two ways in which you can look tax, taking advantage of the tax exemption. The first part is whereby when you are making during your active or during this time of savings, one of the things is that you are given an exemption in terms of taxation up to 20,000 on monthly basis, which is equivalent to 240,000 on yearly basis. So to take advantage of that is that if you're making contribution through payroll or your deduction towards pension is done at the payroll level, it means that the first 20,000 will be exempted from tax, such a way that if I can just give an instance, if for instance you are earning something like 50,000 and you're making a pension contribution of 10,000, it means that the first that 10,000 will be exempted from paying tax, that is at the paying. So for instance, if you are earning 50,000, you are making 10,000 towards your pension. So to means that the taxable income will now be 50,000 minus that 10,000. So the amount that is taxable will be 40,000. It means the first 10,000 has been given an exemption from tax. So that is the first level of taking advantage of taxation. The second level of taking advantage of taxation is the options at the point of benefits payment, is that on yearly basis, when you're being paid your benefits either you have attained your retirement age or on early exit. One thing is that you are given a relief by government of 60,000 yearly up to a maximum of 10 years. So for instance, if you are working in a scheme for more than 10 years, to mean you'll be given 60 times 10. So to mean the first 600,000 will be exempted from paying tax, and any amount which come above there will now attract tax. But how can you take advantage of this is that you can ensure that you increase the amount or the purchase price you are buying an annuity or a drawdown, such a way that, because if you purchase an annuity for 2 million, it means the whole 2 million is being taken to a pension scheme into purchase of an annuity or a drawdown with no any taxation, unless now on the monthly income, whereby there is a taxation, but also there is exemption. So for instance, is that when you access the part which is not taxable and then you use the other remaining portion in purchasing an annuity, you'll have taken advantage of that tax relief provided by government. Thank you. Eve?
Sorry, comment, are you able to hear me?
Yes, Eve, I can get you.
Yes, so the next question is still from Boniface. He's asking, I signed one that expires when I am 50 years. Will I be paid everything at that point, or will it be converted to this annuity?
Thank you for that question, Boniface. I think taking your question is that during my start of my presentation is that there are two ways, there are two structures of a pension of a scheme whereby you need to look into. We have what we call a pension scheme, and we have what we call a provident fund. So in case you are in a pension scheme, it means that during the time of retirement, that is when you attain that 50 years, which I think you call it expiry. However, that will just refer it as we can call it a maturity, or we can call it a retirement age. So when you attain that 50 years and above, it means now if you are in a pension scheme, the law of that or the rules of the scheme, it basically means when you attain that retirement age, 1/3 of your benefits will be paid to you as a cash lump sum, or it means that will be paid to your account directly, while the remaining 2/3 will be used in purchase of what we call an annuity stroke income drawdown. So I think that is something that you need to first of all know which kind of structure your scheme is. However, if you are in a provident fund, it means at the point of attaining that retirement age, you will be able to, it can be paid to you as a cash lump sum in full without using purchase of an annuity or an income drawdown. However, is that from experience, we always advise, even though you are in a provident fund whereby the money can be paid to you in full, it's always very prudent and very important for you to consider purchasing, either having an annuity or an income drawdown, because there are research which shows that those people who take a cash lump sum or they take their money in cash, they say they need to be paid in cash to their account. Within a period of 3 months, the money will be finished. They are given exemption in 2 ways, whereby they are saying some of them will go into business. If you go into a business, remember that you have been working, you have been in employment. You might be getting yourself into a business that you are not much conversant with, and there are two ways, there are two options. It can either be successful or it can fail. And the research which was done back in 2019, it shows that 30% of the people who enter into new business become successful. 70% may fail. So it shows that there is a risk. So the most important thing is to have an income. Ensure that you get either you take part of it and invest on purchase an annuity or purchase an income drawdown, because this one, it will provide you the monthly income, which is a replacement of what you have been receiving as your salary. So to answer your question is that now you need to look into details of your scheme, confirm whether it is a pension scheme or it is a provident. If it is a pension scheme, it means that at the point of your retire, that will be paid to you as a cash lump sum. To that will be used in purchase of an annuity or an income drawdown. I hope I've answered your question, Boniface.
Yes, I think that's a very conclusive answer. Thank you, Michael, for that. Our next question is from Dr. Joseph Kipkorir Rono. He's asking, how do you calculate the monthly payments if one chooses an annuity contract?
Okay. Jonathan, will you take that question or I take the question?
Okay, kindly just take the question.
Okay, thank you. So when it comes now to the main advantage of purchasing an annuity or an income drawdown is now the issue of taxation, because if you let's just give an example, is that let us look at a situation whereby someone has a 3 million upon retirement. So what will happen is that, okay, if you want to use a million, you use it in purchase of you use it to be paid to you as a cash lump sum. The remaining 2 million, you use it to purchase an annuity or an income drawdown. So this 1 million is now paid to your account. This 2 million, with no taxation, with nothing else, is used directly to purchase an annuity. This annuity on estimate is that if you use like for instance 2 million to purchase an annuity, it will give you a roughly something like 20,000 for the rest of your life. And looking into this 20,000, because in terms of taxation is that the first 25,000 of monthly income from an annuity or an income drawdown is considered to be a tax-free amount. So you realize that if someone, for instance, you purchase an annuity of 2 million, which is giving you a roughly 20,000 every month, to me that falls below. It falls under the threshold of being taxed. So to mean already that you use your 2 million in which was supposed to be taxed, but you put it in an annuity or an income drawdown, but it results to you being paid on monthly something like 20,000, which falls below the taxation of the first tax-free amount of 25,000. So in terms of taxation, I think of an annuity, what they normally do is that the first 25,000 will be considered to be a tax-free, and then any amount above 25,000 will be taxed on a graduated scale, whereby the first 33,000 will be taxed at 10%. The next 33,000 at 15, the next 33,000 at 20, the next 33,000 at 25%, and any amount above 133,000 will be taxed at 30%. So you realize that despite there is that taxation, there is also another factor of taking advantage of being given a relief. The first 25,000 is tax-free. So that becomes the basis of how they do the computations of that taxation in terms of annuity or a drawdown. The taxation is almost similar. Thank you.
Okay, thank you, Komen. Thank you, Komen, for that. I think if in case our dear members and clients, if in case you still need more clarification on your queries, kindly feel free to reach us out on our emails, and also we have our open communication channels, which is our phone number is 0709-986-000. And then you can drop us an email at support@octagonafrica.com. This is in case you feel you need more information on your queries. All right, so our next question is from Lillian Kantai. She is saying the guarantee period is when I can have, the guarantee period is when I have paid the annuity, so I can only access after the guaranteed period. So if I start paying today a 5-year guarantee, I can only access the payment in 2026. So kindly debunk that, Michael. I understand Jonathan is also having an issue with his audio. So in the meantime, kindly, Michael, let's answer Lillian Kantai's question.
Thank you very much. I think that question for Lillian, I need a bit to make clarification, is that what happened is this. In an annuity, when you mention about what we call a guarantee period, I would wish us to make it clear that, okay, when you mention about this, what we call a guarantee period, this guarantee period was introduced to to actually protect members from feeling like losing their fund. So let's say, for instance, someone join a fund today. You purchase an annuity today. So and then you said, I want to purchase an annuity with a 5-year guarantee period. What does that mean? It means that whether I'll be alive or I die, it must
Hi,
be paid.
Ignatius. Is this Ignatius? Hello, is this Ignatius?
Sorry, Eve. Okay, so when you purchase a 5-year guarantee, it doesn't mean like it will start at the end of 5 years. It means that whether I'm alive or I passed on, my my annuity should be paid for these 5 years. So what will happen is this: in case I live past these 5 years, it will just continue for life. But in case I passed on within this guarantee period, my beneficiaries will be paid until the time I attain the guarantee period of 5 years. So it doesn't mean that I must survive beyond this guarantee period for me to be paid. No, it basically means I need my benefit to be paid to my scheme, so long I'll be either alive or I'm not there, my beneficiaries will be paid. So basically, you need to understand that the guarantee period is trying to protect that members do not lose, because if you don't have a guarantee period and you pass on year 2, it means that is the end of your annuity. So the reason was introduced is to have this guarantee period. For instance, I think I've seen most of the people taking a 10-year guarantee period. So you see that either you are there or you are not there for the first 10 years, your benefit must be paid. So either if I'm there, I'll be paid. If I'm not there, my beneficiaries will now be paid until the end of that guarantee period, and it will stop. But in case the member would live beyond the guarantee period, that is well and good, because this annuity will run for life. I hope that has been clarified at Lillian.
Yes, I think from your explanation, it's been clear, and also I would want to encourage, if there might be need for further clarification, our communication channels are open, and you can feel free to reach us and you'll be able to get further assistance. Yeah, apologies for that. On the communication desk, we handle a lot of client support, so kindly bear with us. All right, so the next question is from Sarah Kano. She needs clarification on tax implications of annuities.
Thank you. Is it directed to me?
Yes, it's still directed to you because Jonathan is still not able to sort his audio.
Okay, so in relation to tax implication in terms of an annuity, I think I given an highlight that in terms of taxation of an annuity, you not be taxed the purchase price, but you'll be taxed while you are being receiving your monthly income or the monthly annuity payment, whereby they will consider that the first 25,000 is considered to be a tax-free amount, but any amount which comes from 25,000 and above, it will now attract a tax. I think at the rate of, you find that the first 33,000 will be taxed at around 10%. The next grade is 15% for that, another 33. The other 33 will be taxed at 20. The other 33,000 will be taxed at 25%. So and any amount which will come above 133,000 will be taxed now at above 99,000 will be taxed at now taxed at 30%. So you realize there is that scale of taxation. But one thing you need to remember is that you are given a tax-free. The first 25,000 is considered to be a tax-free amount. And secondly, is that upon attaining 65 years of age, is that any income, the monthly income, will now be tax-free. You will not pay any tax. So, for instance, if someone retires 65, you are earning 100,000. This 100,000 will be taxed between age 60 to 65, and then the taxation stop from age 65 because you are considered to be a senior citizen. So that is now the tax implication when it comes to the monthly pension annuity.
Okay, thank you, comment for that. Also from Lillian, she's asking, is there an administrative cost? Who pays and how much? The amount of the monthly payout I get, is it taxable again for those that are above taxable bracket? I think partly of part of that question you have already handled it conclusively. So the only part that might be that might be unclear is there an administrative cost and who pays and how much?
I think when it comes now to the administrative cost, is that this now will depend on the two forms of the option you have chosen. Is that if you have chosen to go with an annuity way, is that you will not pay any administrative cost because the income is guaranteed by the insurance company. However, if you go to the option of a drawdown, I think my colleague had mentioned a bit, is that when you go to a drawdown amount, is that a drawdown amount it provides a monthly income for a period of 10 years. So it is a fund which it runs for 10 years, and then at the end of 10 years, let's say for instance, you pump in, you purchase a drawdown of a certain amount. So at the end of 10 years, you'll have something we call a residual value. And at the end of 10 years, you can ask to be paid that residual value to be paid to you, or that residual value you can continue for a drawdown for another period of 10 years. So when it comes to income drawdown, there is administrative cost, but the regulator, that is Retirement Benefit Authority, has given a maximum that this cost should not go above 1% of the fund. So, but remember that this is not eating into your purchase price or what you used to purchase, because this is just a deduction which is normally done from the investment income. Let's say, for instance, we made an income of 12%. You reduce that fee of 1%, you remain with 11%. So that 11% is what you are distributing to the members as income. So you realize that this administrative cost on income drawdown is normally done on the income, but it needs to be disclosed on the members so that during an annual general meeting. But when it comes to the other side of an annuity, there is no administrative cost because it is a guaranteed, and no matter how they are going to invest, you are guaranteed that they must give you that monthly payment.
Okay, thank you very much, Komen. Thank you for handling and taking those questions conclusively. I think Jonathan has now been able to sort his audio, and I would like him to take these other lot of questions. The next question is coming from Henry Kamau Muigai. He's asking, is the escalation indefinite?
Okay, thank you, Eve. My apologies on my audio issues. I think I have two questions that I would like to tackle. Number one is the escalation indefinite? Yeah, the escalation is indefinite, Henry. Yeah, basically what this means is that the monies that you're earning, the yearly income or the monthly income, will be escalated at a certain percentage. Let me say, for the rest of your life. Yeah, there is no definite length of time that this will stop. Yeah, and then the other question is on Dr. Joseph asked that how do you calculate the monthly payments if one chooses an annuity contract? So, as I had said, for us to get your quotation, we'll need the age, the gender, the purchase price. So this is what our actuaries will use so that they can give us a quotation. And as we know, the men have a shorter lifespan, the women have a longer lifespan. So if we use the same age and the same purchase price and different genders, we have a higher rate for the men and a lower rate for the women. So the men will earn more in a month than the women. This is because, as you all know, the lifespan for the woman is longer and for the men is shorter. Thank you. Oh, there's another question on when are the monthly payouts done? So the annuity payments are paid monthly by the 30th of every month. The insurance companies usually pay between date 21st to 27th. So that's when you'll be able to get the monthly payouts. Thank you.
Okay, thank you, Jonathan, for that clarification. We also have question, and another question is coming from this pension-related question. It's coming from Atonga Moses. He's asking, what happens upon termination? And I'm yet to reach the retirement age. Can I get all the benefits? Kindly clarify for him. Okay, Jonathan, anyway, to Atonga Moses, the law provides the official retirement age to be either early retirement 50 or late retirement at 60. So if you are terminated before the retirement age, you are within your rights to access 100% of your contribution. And also you can access 50% of your employer contribution. The other 50% of the employer is usually locked until you attain the minimum required retirement age by law. Yes, so you can access 100% of your contribution and also 50% of your employer contribution. Yes, I hope that is clear. So the next question, in the respect of time, because I'm seeing we are above the time allotted for this, we have a question from Doris Mavuta. She's asking which is the minimum number of years for saving. Michael, would you want to take this question?
Sorry, pardon your question, please.
Okay, Doris Mavuta is asking which is the minimum number of years that can one save for retirement?
Very interesting question. what we can say is that saving for your retirement, you should start as soon as possible, because looking into the how things are, the experience is that you find as you save, the better, because you have saved enough for your retirement. But if you save late, to mean even if you have saved at the end of retirement period, it would be very minimal. It is good to save because you have a long period of time of savings. Sorry?
Losing you. Your audio is not very clear. Kindly repeat.
Okay,
your
apologies.
answer, as your audio is breaking. Yes.
Sorry. The question that is minimum numbers of years for savings is that I can just say we don't have a minimum years of saving. We don't have a maximum. But even this age, find that one might even be still in a you can just continue saving, so you don't have a minimum or a maximum years of savings. But just to mention is that it is during the period of retirement. Thank you.
Okay, I don't know if it's on my side, but his audio was not very clear. But I think what I've gotten from his answer is that the sooner you start saving for your retirement, the better for you. And also it will ensure that you have a good pension pot that you can retire and that can be able to support your lifestyle as you retire. So so there's no minimum number of years that you can save. The more you save, the better for you, and the better you'll have a better pension pot to fall to once you are not able to actively be in employment and earn a salary. Yes, so we also have another question from Henry Kamau, and he's asking a very important question, because I realized in our introduction comment mentioned about medical insurance, and so Henry is asking, how does the medical insurance option play out on the annuities? So either Michael or Jonathan, kindly feel free to take this question, because I know you have more information that you can give to Henry.
Thank you, Eve. For the medical insurance, how does it play out on the annuities? Yeah, so the medical insurance is not in any way related to the annuities. An annuity is a different insurance product from the medical insurance. So at retirement, you'll be able to take up an annuity, and then you can also decide to take up a medical insurance, which in such cases, you might use your monthly payouts to pay for your medical insurance. Thank you.
Very well, Jonathan. Yes, so I think to our guests for today, and also our clients and members, we are coming to the end of the session. We thank you so much for taking the time to engage with us and also to listen to us. We don't take that time for granted, and we want to inform you that this session takes place, it's a bi-weekly session. So skipping next Friday, the other Friday we'll also have another session. So if you want to have more clarification, or you have you would want to join us, you feel very welcome. And also we have our communication channels, which are always open to our members and clients. Feel free to call us on 0709-986-000, and also you can drop us an email at support@octagonafrica.com, and we'll be able and we'll be happy to help you with any nature of inquiry that you will have. So with that, in that regard, and also in respect of time, I would want to appreciate you. I would want to appreciate my colleagues for handling this session and also making time and also presenting and also engaging with you. I would also want to appreciate you for your time and also wish you a happy weekend and a restful weekend ahead. So I would want to call this meeting to adjournment and also wish you the very best till the next time. Goodbye.